Dan, thank you for that. Let's bring in Alex Booth. Alex joins us this morning from Kepler. He's head of market analysis there. Alex, as we look at the key actors in this ongoing dance, who is it that's really resisting the continuation of the ongoing cuts at this point?
Hi, good morning. Yeah, it's a good question. I think it's the usual suspects that we were talking about ultimately at the start of the year before we had the situation in the spring. There's a lot of pushback from Russia, and more recently there's been a lot of pushback from the UAE. There's new discoveries in the country. There's been a lot of capex in the country, and they want to ultimately make the most of that. But saying that Russia kind of is pushing back on this is they have actually been kind of following the agreement quite well. Their exports through November were pretty much flat with October, whereas in other countries we have actually kind of seen small increases. Some of them, places like Libya, where they're allowed to increase, and other countries where they should be kind of still capping their production and exports anyway.
As we look at the headline price here, I mean, we've been in this sort of $45, $50 a barrel range now recently. And I think some of the oil producers may actually be pleasantly surprised that we've managed to get back into this kind of level. What is your expectation as to how that price will evolve through the end of the year and into early next year here, as all the positivity around the vaccines continues to drive other risk assets higher?
Yeah, I think there's likely a natural cap which comes in the form of the US producers. Ultimately, if we introduce kind of significantly more production at the moment, or kind of over the course of the next 3 to 6 months, I think that's going to be met with pressure on the demand side, which is just continue to underperform on a global basis. There are regional kind of variations in that. But I think when you start to kind of get up to the 50 level, you will start to see more production coming out of the US. Ultimately, that's going to be pushed into the international markets, and I think that's going to keep a bit of a price cap there.
Alex, just talk us through how brutal this current second wave has been for the oil market, because we went into lockdowns in various different countries and more restrictions, and we thought once we came out of the lockdown that we'd have more normal patterns that would emerge, but that's not been the case coming up to key holiday season. So what has that meant for the oil market as key leaders sit down to debate the backdrop for energy?
Yeah, I think anyone sitting here in Europe is feeling that completely. I think the data that comes out of the US in terms of the Thanksgiving demand is going to be a good precursor for the rest of December, kind of certainly across Europe. The measures that are being put in place to limit travel and so on, and also the personal decisions that are being taken by people across the market. I think at the moment, we are in a kind of fairly stable position. So demand has improved. Clearly, things in Asia are much better. If you look at, say, crude imports into OECD Europe, quite a bellwether for what's happening in the COVID environment or post-COVID environment. We have increased imports over the last few months. However, we're still down just over 1 million barrels a day in terms of crude imports versus Q1 of this year. So I can understand fully why there is such kind of contention within OPEC Plus, because depending on which data set you're looking at, you can really kind of cherry pick your data to say, okay, well, it's a much more constructive market. Ultimately, we've built so much inventory onshore this year. We're up just about 284 million barrels year on year by the end of November in terms of our tracking. Yes, we have drawn down that crude that has been sitting on the water for so many months, but that drawdown has slowed down. So we went from September being about 1.5 million barrels a day of oil coming off the water through to November, where that's just under 500,000 barrels a day. So any significant increase in production here, as kind of discussed by various members of OPEC, I think are going to weigh heavily on the market. at this point in time, and certainly through the rest of winter, where it's hard to see any significant demand recovery in the Western Hemisphere at least.
Alex, just quickly, we've had a discussion on markets about the very quick recovery in some areas of asset classes where you've seen a full pricing of recovery effectively, but not in the oil market. We're still about, what, $15 odd off where we started out this year. What's it going to take to get the oil price back to that level?
Well, I think the oil market's different. If you're looking at, say, equities, where the oil market is a futures market, if you want to, if you have the expectation that oil is going to recover through the spring of next year, well, you trade that contract. You don't trade the January contract because you think that demand is going to be better by June, essentially. And so the structure in the oil market is essentially giving us that signal. We were discussing earlier, we flirted with backwardation last week. That's now come off into contango, where the kind of future prices are higher than current. And that's really how the demand situation is going to be expressed, because ultimately any increase in the absolute price, as I was saying earlier, is just going to incentivize more production when we don't need it, basically.
Alex, thank you very much for joining us today. Alex Booth, Head of Market Analysis at Kepler.